Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the dominant, independent force in programmatic advertising, the trade desk, ticker symbol TTD. When we talk about digital advertising, we're really talking about a colossal market. I mean, the entire global ad ecosystem is pushing nearly $1 trillion.
It's just massive.
And the trade desk, TTD, is without question the leader in the fastest growing part of that market, what we call the open internet. But, and this is the big but, despite that dominant position, despite their proven financial health, the stock has been absolutely ravaged in 2025.
And that is the ultimate paradox we're here to unpack for you. It's just a fascinating situation.
It really is.
You're looking at a company with really strong profitability, undeniable market leadership. Their operational success got them into the S&P 500.
Right, in July of 2025.
Yeah, and that's a huge milestone. They were the first independent ad tech company to do that in something like 2 decades. That alone tells you something about their scale. We're talking $2.44 billion in revenue last year, $12 billion in spend on their platform.
So the business quality is there, the market recognizes that, but then you look at the stock price and it's just telling a story of pure panic. TTD has been so battered this year, it's fallen over 60% from its recent highs.
Pushing all the key valuation multiples down to levels we just haven't seen in years.
Exactly.
It's that classic disconnect, The business fundamentals look solid, but the investor sentiment is just rotten. So why is the market punishing a leader so severely?
That's the question.
It suggests that at least some investors believe this recent slowdown in their growth is, well, that it's structural, that it's permanent, and that it signals the walled gardens are finally, winning.
So our mission today is to look right past that market fear. We need to dissect TTD's Q3 2025 performance. We're going to analyze its recent strategic moves, especially a really interesting B2B data partnership, and evaluate just how strong its competitive moat truly is against these giants like Amazon and Google.
And, most importantly, we need to figure out if the massive internal tech drivers they've been investing in suggest a powerful return to high growth in 2026, or if this slowdown really is a structural problem that Jeff Green and his team might be underestimating.
All right, let's start with the financials. The latest report, Q3 2025, which came out back on November 6th. On the surface, the numbers looked pretty good.
Yeah, they beat expectations.
Revenue came in at a solid $739 million, and the headline growth rate year over year was 18%.
Right, and that 18% is where you really have to dig a little deeper, because it's not truly representative of what's going on under the hood.
Because of the comps from the previous year.
Exactly. We have to talk about the political advertising spend from Q3 2024. That's what's skewing this comparison.
So can you quantify that impact for us? How much did that really move the needle?
It was significant. Q3 2024 got this huge benefit from U.S. political ad spending, which just made it an abnormally high bar for 2025 to clear.
Right.
So when analysts model TTD's performance and they strict out that political spend from the 2024 baseline, the underlying growth rate for Q3 2025, it jumps to an estimated 22%.
22%. Okay, that's a crucial piece of context.
It's a huge insight. It means TTD wasn't just growing by 18%. They were actively taking market share at a 22% clip, all during a quarter where the rest of the ad industry only grew by, maybe 7%? They are still eating the market.
Okay, so 22% underlying growth is excellent. But that's not the primary concern for investors, is it? The real panic is that they're slowing down from their own high watermarks.
That's precisely right. But before we get into the whole deceleration anxiety, we have to talk about their financial health, because this is what really separates TTD from that whole cohort of volatile growth stocks.
They're profitable?
They are fundamentally profitable. GAAP profitable, which is, as you know, notoriously difficult in ad tech.
Yeah, with all the R&D and platform investment, it's very rare.
And they've been GAAP profitable every single year since they went public. Just look at Q3 2025. The adjusted EBITDA margin hit an incredibly strong 43%. That's $317 million in adjusted EBITDA.
So you have this combination of 22% underlying growth with a 43% margin.
It's spectacular operating leverage. It really showcases the beauty of a self-serve software model that just gets more and more efficient as it scales.
But let me play devil's advocate here. A 43% adjusted EBITDA margin is fantastic, no doubt. But is that sustainable? I mean, if TTD really needs to ramp up R&D to fend off the sheer scale of Google's AI or Amazon's resources, Are they maybe being too conservative on spending?
That's a very fair and critical question.
Are they prioritizing short-term profitability over the kind of aggressive reinvestment they might need to guarantee 30+% growth in the future?
I think management's response, and this is really the core of the whole thesis, is that TDE's platform, because it's an objective marketplace, it just inherently needs less operational overhead. They don't have to maintain massive proprietary inventory. They don't have huge sales teams to push that inventory.
Right.
Their R&D is laser-focused on efficiency, on AI with Kokai, and on supply chain integrity with OpenPath and OpenAds. These are cost reduction plays that also happen to drive higher client spend because the performance gets better. So they would argue that high margin is sustainable.
Because the business model itself is just structurally superior for the buyer.
Exactly. It creates this self-perpetuating flywheel effect that doesn't require them to just keep throwing more and more money at it.
All right, so let's pivot to the thing that's actually dominating the stock price, this deceleration concern.
The market is just obsessed with momentum. TTD started 2025 so strong. Q1 was 25% revenue growth, plus a record 7.1% beat over guidance.
Which set the bar incredibly high.
Impossibly high. Then momentum slowed to that 18%, or 22 adjusted, in Q3. But the real alarm bells, they went off with the Q4 guidance.
That guidance suggested that top-line growth would fall back even further to just under 13.5%.
Exactly. And even if you factor in the macro pressures, softness in auto and CPG, that kind of thing, a drop from 25% growth down to 13.5% in just 3 quarters, it spooked the market.
Yeah, it's a steep drop.
Investors started to fear that this was it. This was the signal that the structural competitive threats were finally biting and that TTD was just running out of steam.
Which brings us to management's response to that fear, which was extraordinary, the capital return program.
It was not a regular buyback.
Yeah.
It was an aggressive, very loud signal.
It felt like a statement.
A very clear statement. Jeff Green and the team believe this stock is deeply, deeply undervalued. In Q3, they deployed $310 million in cash to repurchase their own stock.
That's a staggering amount for a tech company that's still supposed to be in a high growth phase.
And then they used the remaining $60 million in October, right as the stock was hitting new lows.
And we know exactly when they were buying because buybacks were heavily concentrated in the mid-$40 and mid-$50. They were buying right into the fear.
Yes. And they didn't stop there. They backed it up by authorizing an additional $500 million for the program, all funded by a fortress balance sheet. They're sitting on $1.687 billion in cash, which just dwarfs their debt of $344 million.
The optics are really crucial here.
They are. TTD is returning roughly 210% of its quarterly free cash flow to shareholders. Think about that. That is a massive deployment of capital.
So I have to ask, why buybacks and not a dividend? A dividend can signal stability. It can offer a floor for long-term investors.
For a growth company, buybacks are just much more strategic. A dividend is a permanent commitment. It signals confidence in your current cash flow. A buyback signals confidence that your stock is intrinsically undervalued.
So they believe the highest return on their capital is just buying their own shares.
Especially when they're trading at historical lows, yes. Plus, buybacks help offset the dilution from stock-based comp, which is, it's everywhere in tech. It's management looking at the market and saying, we see a disconnect and we are going to capitalize on it aggressively.
Right. If the competitive threats were truly catastrophic, this would be reckless.
It would be reckless, not strategic.
Okay, so we've established the money is sound, but the momentum is weak, and it needs a powerful catalyst to get going again. So let's pivot to how they're building that future momentum. And that brings us to a really smart strategic play in a messy, messy segment, B2B advertising. Let's unpack this Intuit partnership.
This deal, which was finalized on November 24th, 2025, it's a masterstroke. It really is. It leverages TTD's platform strength to solve a huge industry weakness.
And that weakness is B2B targeting.
The B2B ad world has always been the wild west of data. It's just so fragmented.
Why has it been so hard to get right, historically?
Well, it comes down to context and signal quality. If you're selling, say, a pair of sneakers, you can rely on demographics, purchase history, that kind of thing. But if you're selling B2B software, like a new fleet tracking system,
you need to find a very specific person.
A specific decision maker at a specific type of company based on their actual operational behavior. Historically, marketers just use these fragmented, often outdated third-party data lists. It was scraped data, inferred data.
Which led to a ton of wasted ad spend.
Massive wastage. You end up targeting a CEO who retired 2 years ago, or a small business that's already locked into a competitor's product.
And yet, this is a giant high-value segment.
Colossal. Small businesses are 99% of all companies in the U.S. Millions of high-value decision makers. And finding them accurately across the open web, especially in something like connected TV, has been close to impossible.
So how does Intuit solve that data quality problem?
It all comes down to the source of the data. Intuit is a financial tech platform. They sit right at the center of a business's operations. They own QuickBooks for accounting, TurboTax, Credit Karma, MailChimp.
These are core business functions.
Exactly. So the audience segments TTD is getting access to are derived from aggregated, de-identified insights from these core products.
So we are talking about deterministic data here, not inferred data.
That is the absolute key differentiator. Inferred data says, hey, this IP address might belong to a business owner because they visit these websites. Deterministic data says this de-identified profile is actively using QuickBooks to run payroll for 15 employees and just file their business taxes.
It's based on actual business activity.
Actual usage patterns, financial activity, which, as Intuit's director of SMB Media Labs, Christopher Moneta, said, it establishes a new standard for relevance. It just completely solves that problem of high-value B2B targeting.
And this is where TTD's role as that objective hub is so critical. Why them? Why not Google or Amazon?
TTD is the first demand-side platform where this data is discoverable. Walled gardens are great at monetizing their own audiences, but Intuit's expertise is finance. It's not media. They needed a partner who could take this incredibly high-quality, very sensitive data and make it actionable everywhere.
Across the whole open internet.
Across every streaming app, every website, every audio platform. They needed an objective partner who wasn't going to compete with them.
And since we're talking about highly sensitive financial data, we have to talk about the tech here. You mentioned clean room technology. For someone who hears that term a lot, what does it actually mean in practice?
A clean room is basically a secure, neutral digital space. It's where two or more parties can bring their sensitive first-party data together to analyze it and create audience segments, but, and this is the key, without ever exposing the raw, identifiable data to each other.
So it's an enforced privacy mechanism.
It is. So in this case, Intuit and an advertiser can query the data to target, say, business owners who bought X software in the last 6 months. But the advertiser never sees the names, the bank details, any of that specific financial info. The data is all aggregated and de-identified before TTD even gets the signal.
That makes perfect sense. So you get the precision targeting without breaking any privacy standards.
Exactly. And the whole thing is distributed through the LiveRamp data marketplace, which is a major identity provider. So it's all anchored to these persistent privacy-preserving identifiers. This whole architecture just aligns TTD perfectly with where the industry is heading.
And it's omni-channel, not just web banners.
Correct. It's connected TV, audio display, digital out of home. Imagine you're a marketer trying to reach small businesses that just hired their first 5 employees.
Right.
Instead of using some generic demographic segment, you can now use this deterministic data to hit them with a relevant ad for a new payroll service, whether they're streaming a show at night or listening to a podcast on their commute. It's a game changer.
It really solidifies their position in that specialized B2B space.
It does. We saw MNTN do a deal with ZoomInfo earlier in the year. This is a high-growth area, and TTD is making sure it's the objective, independent path for the absolute highest value data out there.
Okay, so this brings us to the existential threat. The reason the stock is down 60%, the perceived competitive gravity of Google and Amazon. The market seems to believe that TTD's objectivity is a quaint idea that just can't withstand the sheer scale of the giants. But TTD's leadership argues that their whole moat is built on the fact that they are not a walled garden.
That independence is the structural bedrock of the entire business. Jeff Green founded the company on this premise. The ad buyer needs an agent, an advocate, whose only interest is minimizing cost and maximizing performance for them.
So they don't own or monetize ad inventory.
Right. They don't run an exchange. They don't own YouTube or Prime Video.
So how does that really create a moat against a company like Google, which owns everything, the exchange, the inventory, the buying platform?
It's the fundamental conflict of interest. Google's DSP is designed, at the end of the day, to maximize the yield of Google's own supply. It has an inherent incentive to prefer YouTube inventory, even if it's not the most efficient buy for the advertiser.
Whereas TTD's platform.
is designed purely to minimize the buyer's cost and maximize their outcome across the entire open internet. Green's quote nails it. "We do not compete with our clients, we're an objective partner." If you're an advertiser spending billions, you need to trust your agent is only working for you.
And that objectivity shows up as transparency. That's the technical moat they build.
Absolutely. The transparency mode is massive. In a lot of these integrated platforms, the cost structure, the auction mechanics, it's all a black box. TTD, on the other hand, gives you detailed cost breakdowns. They let agencies export the raw log data for their own analysis.
Let's quickly explain why that raw log data export is so valuable.
Sure, raw log data is the full, unabridged record of every single ad impression, every bid, every dollar spent, and all the context around it. If you're an agency spending $10 million, having that data means you can audit TTD's platform yourself.
You can run your own models.
You can confirm exactly where your money went. It eliminates the ability for TTD to hide fees or inflate metrics. That level of auditable visibility builds incredible trust, especially with the big holding companies and CMOs who demand that accountability.
Okay, now let's address the elephant in the room, Amazon. The bear narrative is that Amazon's $70 billion ad business is just directly stealing TTD's growth. That's why we're seeing this deceleration. So how does Jeff Green publicly dismantle that?
His argument is really sophisticated, and it forces you to take a more nuanced view of the market. He contends that Amazon's giant ad business is almost entirely focused on monetizing its own inventory.
Their owned and operated stuff.
Exactly. So he argues they aren't really playing in TTD's sandbox, which is the open internet.
He broke down those revenue streams for us.
He did. He estimates that 90 to 95%, maybe even more, of Amazon's ad revenue is just sponsored listings, the product ads you see when you search on Amazon.com.
Which, he argues, competes with Google search.
Right. And then the second biggest piece is Prime Video advertising, which is competing with Netflix, Disney, and the other streamers for those big TV budgets.
So his conclusion is that Amazon's actual presence in the open internet DSP space
is tiny. His crucial estimate is that it's in the low single digits. So he concludes, very little time and money is competing with us. The reality is we're playing in a very different sandbox.
It's a compelling argument. But let me offer the skeptical counterpoint. Even if Amazon's open internet DSP is only 5% of their business, Amazon is famous for aggressive expansion. They subsidize loss leaders all the time to grab market share. Isn't the real risk that Amazon just targets the highest value customers in TTD's ecosystem, those CPG and auto multinationals, and that even a small targeted market share grab by Amazon causes a huge ripple effect for TTD?
That is the structural anxiety that's driving the stock price.
Absolutely.
The bears worry that Amazon's push into third-party marketplaces and their simplified ad tools just make it harder and harder for TTD to maintain its premium pricing.
Right.
But TTD's response to that, especially in the crucial retail media space, I think it actually reinforces their structural advantage.
Okay, let's elaborate on that retail media strategy.
TTD uses what you could call a federated approach. They know Amazon is this massive closed loop. If you're an advertiser, you can't measure your ad effectiveness outside of Amazon's walls. So TTD positions itself as the objective partner for all the other major retailers.
Walmart, Instacart, Kroger.
Kohler, Ocado in the UK, major grocery chains.
Yeah.
They help them activate their first-party shopper data across the open internet.
So instead of being one massive walled garden, TTD is building the plumbing to connect dozens of smaller, high-quality gardens.
Precisely. This allows brands to use SKU-level purchase signals for targeting and measurement across multiple retailers, all outside of Amazon's ecosystem. If you're a brand that sells through Walmart and Kroger and Instacart, you don't want to rely only on Amazon for your measurement.
You want an objective partner who can unify all that data.
Exactly. TTD becomes the only neutral party that can deliver that multi-retailer targeting and unified measurement. It's just impossible to do that within the Amazon framework.
So ultimately, the debate really boils down to an architectural choice.
It does. Is the long-term winner the company that owns the inventory or the company that guarantees the most transparent and efficient execution across all the non-owned inventory?
And if you need some external validation on that, the independent analysts seem to consistently back TTD's position.
They do. Forrester Wave named TTD a leader in omni-channel DSPs in Q3 2023. They specifically called out their strategy and their prescient bets on CTV and identity. They got connected TV right years ago, and they got first-party data identity right.
And there's the IDC report, too.
Yes. The 2025 IDC MarketScape recognized TTD as a leader in worldwide connected TV advertising platforms. They gave them the highest scoring capabilities. That's a huge third-party validation of their technical superiority in CTV, which is their most important growth engine.
Okay, so if the risk from Amazon is overstated, as Jeff Green claims, then the solution to this 2025 slowdown has to come from inside the platform. What is TTD building on the tech side that is going to force a reacceleration in 2026? Let's dive into Kokai.
Kokai is arguably the single most important variable for 2026. It's TTD's AI-driven programmatic buying system. We're talking about the largest platform upgrade in the company's entire history.
It's not just a new feature.
No, it's a complete re-engineering of the bidding engine to leverage AI and machine learning at a scale that just wasn't possible before.
Okay, but again, let me be a little skeptical. Every tech company says they have a new AI layer. We're an AI company now. What makes Kokai different? How is it tangibly moving the needle right now?
The difference is measurable performance, and the fact that this transition is almost done. Full client usage is expected by the end of 2025, and about 75% of spend is already being routed through Kokai.
So the adoption rate is high.
Which tells you clients see the value. And the value prop is simple: better performance.
Okay, so let's quantify that. You mentioned some specific case studies.
Yeah, the data is really compelling, and it directly counters that whole deceleration narrative. Clients who move the majority of their spend to Kokai are increasing their overall TPD spend more than 20% faster than clients who haven't fully switched over yet.
So that's the growth catalyst right there.
That's the engine. It's an efficiency engine that encourages higher spending because it delivers better outcomes. We're seeing performance lifts that are consistently over 20 points on key KPIs. Samsung saw a 43% increase in target reach in Europe. Cashwords, a client in Asia, cut their cost per acquisition by a staggering 73% using Kokai.
So the argument is that Kokai improves the efficiency of ad spend so dramatically that advertisers are encouraged to shift budgets from less efficient platforms, maybe even from the walled gardens, onto TTD.
That's the management thesis in a nutshell.
And the 2025 slowdown was in part just the disruption of managing this massive platform transition. Once it's complete, the flywheel spins faster.
That's it. And the other side of that coin is TTD's effort to clean up the programmatic supply chain itself. This is where transparency meets execution with OpenPath, OpenAds, and PubDesk.
Okay, let's dissect this open internet flywheel, starting with OpenPath.
OpenPath, launched in 2022, is their direct publisher integration initiative. The goal is simple: bypass all the intermediaries, all the supply-side platforms and resellers that add fees and reduce transparency and just drain money out of the system.
So it creates a cleaner, cheaper, faster path for the buyer.
And the results for early adopters are dramatic. Publishers who cut out those middle layers are seeing huge revenue spikes. The New York Post saw their programmatic display revenue jump 97% with OpenPath. Hearst Newspapers got a 4-fold improvement in their fill rate.
Wow.
This is powerful evidence that TTD isn't just building a better DSP, they're actively trying to restructure the entire economy of the open internet.
Then OpenAds, which launched in October 2025, seems to tackle the integrity of the auction itself.
Right. If OpenPath cleans the pipe, OpenAds makes sure the auction inside that pipe is honest. It's an auction platform built on the pre-bid standard, which is the open-source tech publishers use to gather bids. Its whole purpose is high integrity.
Reducing things like bid duplication.
Exactly. Reducing bid duplication, eliminating arbitrage, and just ensuring that the highest bid actually wins the impression, which sadly hasn't always been the case in programmatic.
Let's take a moment and explain why bid duplication has been such a problem.
Sure. It happens because intermediaries or exchanges sometimes show the same ad inventory multiple times through different paths. It creates this false competition, it artificially inflates prices for the advertiser, and it just erodes trust.
So by building on the pre-bid standard
And coupling it with the direct connection from OpenPath, TTD ensures the auction is clean, transparent, and fair. It provides the highest integrity signal in the market, making every dollar spent on TTD more effective.
And finally, PubDesk seems to complete this flywheel by empowering the publisher.
PubDesk is the transparency tool for the publisher side. It's a dashboard that gives them detailed signals on how TTD's clients actually value their inventory. They can see which ad formats, which pages, which user segments are driving the highest bids.
Which lets them clean up their own supply and align it with what buyers actually want.
Exactly. And that alignment, where clean pipes lead to truthful auctions, which feeds back into better publisher inventory, that results in higher spend. It completes the self-reinforcing flywheel.
So we have these powerful internal mechanisms driving efficiency. But we also need to talk about the external channels where the growth capital is flowing. And connected TV is still the biggest story.
It is TTD's #1 growth engine, period. Video, which is mostly CTV, was about half the business in Q3, and this trend is not stopping. The CTV ad market is forecast to grow at an exceptional 21.2% compound annual growth rate. It's going to be over $31 billion by 2027.
And TTD is perfectly positioned.
Perfectly, leveraging their early bet on identity and their deep integrations with Disney, Comcast, Netflix, all the major players.
And the growth isn't just organic. It's also driven by these structured high-commitment partnerships, the joint business plans.
The JBPs are critical. The number of live JBPs is at an all-time high, with about 100 more in the pipeline. And this is a key metric because spend under JBPs is growing significantly faster than the overall platform spend.
And these are major enterprise clients committing multi-year budgets.
Right. It locks in high-value spend and gives TTD tremendous revenue visibility, which directly counters that narrative of competitive erosion.
Okay, let's pull all this together and look ahead to 2026. Analysts are currently forecasting growth to be pretty conservative, around 16%. What are the major catalysts that management is counting on to push that growth back above 20% and finally silence this fear?
Well, there are about 9 key pieces to this puzzle that, when you put them together, make a really strong case for reacceleration.
Okay.
First, the internal tech engine. The full transition to Kokai will be done, which will keep yielding performance benefits and incentivize more client spend. Second, the increasing activation and growth from the JBPs will become a larger part of the overall revenue.
Third would be the strategic partnerships, like Intuit.
Right. Bringing in these high-value, deterministic B2B audiences, unlocking massive new budgets. Fourth, they'll be lapping much easier comps from 2025's platform upheaval. So the 2025 slowdown basically acts as a technical reset for growth rates.
Then you have macro pressures easing, international business growing faster.
Exactly. And then, seventh and eighth, you have the huge external events that always boost ad spend. The Winter Olympics in February 2026, and then the World Cup in the USA in June and July. These are monumental global ad events.
And the ninth point, crucially, must be that TTD's clean pipes open path and open ads will ensure they capture a disproportionate share of that new Olympic and World Cup money.
Precisely. All of these factors combined suggest that the current 16% consensus forecast is just far too conservative. TTD's tech and their sales execution seem poised to capture a huge amount of global ad spend.
So we've reached the crux of the debate. The reason the stock is so volatile, on one side, you have these external market fears, a cyclical deceleration combined with the sheer gravity of Amazon.
And on the other side, you have this compelling internal momentum, Kokai, strategic partnerships like Intuit, and the promise of these massive global events signaling a powerful return to growth.
So the investment thesis really hinges on the belief that this is a high-quality, profitable leader with deep moats built on objectivity and superior tech.
And that the stock price drop is driven by the market mistakenly thinking the 2025 slowdown is structural when all the evidence really points to it being cyclical and transitional.
So let's look at the resulting valuation, because the market's fear has created a violent historical discount.
It really has. The stock is trading near its 52-week lows in the low to mid $40 range. And just look at the multiples. The forward EV to sales multiple right now is 8.1. That is dramatically below its historical median of 14.2.
Let's put that 8.1x EV sales in context. What kind of business usually trades at that multiple?
Typically, a multiple of 8 to 10 is reserved for a well-established, profitable SaaS company with pretty moderate growth, in the 12 to 15% range.
Okay.
For TTD, a company with a 43% EBITDA margin that's expected to get back to 20+% growth next year, that 8.1 multiple is an extreme disconnect. The market is pricing it like a stable utility, not a leader poised for a growth inflection.
And the profitability multiples tell a similar story.
They do. The forward price-to-earnings ratio at 27.7 is also at historical lows. When we look at growth stocks, the PEG ratio, PE, divided by the growth rate, is often the clearest metric.
And where does TTD stand on the 2026 PEG ratio?
Based on the current consensus forecast for 2026, a PE of 25.5 and EPS growth of 20.8%, the PEG ratio is forecast at 1.2.
And anything near or below 1 traditionally signals undervaluation?
Right. At 1.2, it's nowhere near the premium valuation TTD has historically commanded. Some analysts, based on their DCF models, calculate an intrinsic value around $65 to $66, suggesting the market is overcompensating on the downside by almost 50%.
So let's wrap this up with the ultimate risk-reward calculation.
The upside relies entirely on Kokai's full adoption and the accelerated growth from JBPs, proving that the 2025 slowdown was, in fact, transitional and not structural. If they hit 20 to 25% growth in 2026, the current valuation is highly attractive.
And the downside risk
Is that high competition leads to continued deceleration, falling even below that conservative 16% forecast. That would signal that Amazon's gravity really is pulling the premium end of the business away.
But the critical signal here is the money. Management's aggressive share buybacks, deploying hundreds of millions of dollars. It signals extremely high confidence that they can get back to that 20+% growth in 2026.
This has been a true deep dive, a fascinating company at a major inflection point. It really comes down to trusting the technology and the mission versus fearing the giants.
And the ultimate decision for you, the advertiser, is whether you believe in scale or neutrality. The Trade Desk is building this transparent global railway system for the open internet. They're the objective, efficient path.
While their rivals, Amazon and Google, are focused on maximizing profits inside their own exclusive freight yards. So for the buyer, as the world moves to first-party data and more privacy regulation, which structural choice offers the highest advantage? Is it possessing the inventory inside a closed loop or guaranteeing the objective, efficient, and transparent path across the entire web? That is the question that will determine TTD's stock price for the next decade.